Okay, normally I wouldn't start with the additional information, but we need it to begin here. The first one that I've highlighted in pink, that just gets disclosed. So we don't actually use that in the financial statements. The loans to employees are due this year, so that becomes a current asset to us because it's a receivable. The note receivable is due in two pieces. Well, in several pieces. So we have a $66,000 due September 30th, and the interest is payable annually, so we have to break that out like that. Then we have the short-term investments consist of marketable securities that the company plans to sell in 2014 and $66,000 in treasury bills purchased that mature. Well, the ones that we plan to sell, they still stay just marketable securities. It's a current asset. The T-bills that we are going to redeem, they become current, so we need to take these short-term investments, okay? And we have to break out those receivables, the current note receivable current portion, we need to break that out. So again, we have to break out from the 214, we have to break that out. We get 148 in securities that we're going to plan to sell but may not, and 66 that will be maturing, so we will be getting those. And then they tell us unearned revenue represents payments for extended contracts. 70% of these expire in 2014. They're liabilities, and the notes payable are liabilities, so we'll come back to them when we get to the liability section. So now that we have that, let's go through and take a look at our assets. And I'm going to go through and I'm going to pick out the current assets, and I'm going to highlight those in green. So the current assets are green. So cash is always a current asset, obviously. Now we have marketable securities, okay? And the marketable securities were short-term investments right there. Short-term investment is a marketable security. And then we have accounts receivable. Remember our mnemonic device, CS-RIP, okay? And then we have loans to employees because they're due this year. That's a current asset. Now we have some interest receivable of $28,000. Our receivable is a receivable, so that's a current asset. And we have the current portion of our long-term debt. That's that piece. And then we have our inventories of 231. That's the I in CS-RIP. And then last but not least, we have our prepaids, and they're always the last one. And our prepaids are, where are they? Right there, 32,000. So that's our current assets. And now the next thing, if we have investments, we treat those, they go next. So when we have investments, we have this piece, and that's the note receivable, and we have the balance of the long-term investments of 51. And long-term investments are more liquid, they sell more quickly than property, plant, and equipment, but they're not current assets, so they're the next category. So you have the current assets, then you have investments. So we need those pieces. We put those pieces together, and our current asset and our investment section of the balance sheet gives us $315,000 so far in assets. That's not the total assets, okay? So we have our current asset number, and then we have our investment number, and we have to keep going. So the next piece of this is our property, plant, and equipment. and I'll highlight those in green. So first thing we have is, and in the property, plant, and equipment section, the tangible assets, you have to have the tangibles before the intangibles, but there's no real order within those, as long as you have the macro order. So you have the current assets, then you have the investments, then you have long-term assets, tangible, then long-term assets, intangible. So our property, plant, and equipment, land, buildings, machinery, I'll highlight those in green. That's land, building, machinery. That forms a group, but we have to remember to get those two because the accumulated depreciation has to be shown with the building and equipment. So that'll give us those. Now, on our patents and our franchise, and I'll do those in blue, just make it a little easier to see. Our patents and our franchises, they're carried at amortized cost. So if you have a franchise that you're amortizing, or you have a patent that you are amortizing, you don't have an accumulated amortization account. You simply reduce the asset directly. So when you recognize amortization expense for a patent, you would debit amortization expense and credit the asset patent to reduce it to its net realizable value. And when we do that, that's the balance of our asset section. And when you add up all of our assets, the current assets, the investment assets, the building, property, plant, and equipment, minus accumulated depreciation and intangibles, we come up with a total of $3,193,000 of assets. That's what we're hoping our liabilities and equities amount to. When you think about current liabilities, think about the liabilities that will be paid first. Things that will always be paid first are your accounts payable, because they're your normal, ordinary business dealings, and your dividends payable, because by definition, dividends payable are always a current liability, no matter when. I mean, even if your company declares a dividend to be paid in the year 3971, that dividend, as once declared, is a current liability. So we take these pieces, accounts payable, dividends payable, interest payable, taxes payable, they're all current. There's one here that you might have skipped. And where is it? Unearned revenue. So that's the one that people tend to forget. Unearned revenue is a current liability. So let me highlight the current liabilities again for you in yellow. Accounts payable, current liability. Dividends payable is a current liability. And that could be payable 1/16/2020. It doesn't matter. It's an immediate current liability. Interest payable is current. Taxes payable is current. And the one that people tend to forget is unearned revenue. Okay? Now, the unearned revenue, remember, we have to go back and adjust, because in the additional information, we were told that 70% of these expire in 2014 and the remainder in 2015. So we want to keep just those that will not expire. They're the current ones. So we need, of that 76,000, I'm going to break that into two pieces. 76,000, we need 70% of that for the current portion, and the remaining 22%, or not 22%, 30%, or the remainder of those our long term. So when we do that, we come up with the current portion of that is 53,200, and the remainder is 22,800. That's another piece that you could have forgotten. So you have to make sure you catch these pieces as we go along. And then we have the notes payable. That's a non-current or long-term. And then we have our equity, and we put those together in order. We come up with that for our liability and shareholder equity section. And you notice we have indeed adjusted the unearned revenue account into two pieces, recognizing the 70% that we'll use this year and the 30% remaining. Okay, that's a pretty good balance sheet problem. Takes you through it step by step. Have fun. Once you master one, they're all the same.